Good morning or afternoon, and welcome to the Q2 2023 review webinar. I'm Kyle Wilson, Portfolio Manager here at SIA Wealth, and I'm here to chat a little bit about the year so far regarding the SIA Wealth Management sub-advised mutual funds with BMO Global Asset Management. So in this webinar today, we'll just have a look at some of the relevant major index returns. I'm just looking to paint a bit of a picture for 2023 so far. And after that, we will get into the portfolio positioning, year-to-date performance, as well as Q2 performance. And then lastly, some relative performance analysis for each of the funds relative to each benchmark. To set the tone for a review of all of the sub-advised mutual funds, we'll take a look at the monthly index returns for some large relevant indexes here in the S&P 500, the MSCI World, the NASDAQ, as well as the TSX Composite. You know, after a rocky 2022 that all of us probably still can remember, market rally resumed here in January of 2023, where we saw everything that lagged or really performed poorly in 2022 bounce back with quite a bit of conviction. Conversely, those defensive sectors that really outperformed in 2022 were those that lagged in January and so far into 2023. So we saw a bit of a shift really that started at the beginning of the year. So far this year, the NASDAQ has led the way with more tech growth and risk-on type stocks performing exceptionally well. The MSCI World and the S&P 500 have seen similar monthly returns so far this year, with the TSX Composite starting off really quite strong in January. However, has had a much more lackluster rest of the year, returning a negative cumulative return in the following 5 months. So first, let's just take a look at the BMO SIA focused North American equity fund. So the portfolio as the end of the quarter, geographic weight is overweight to US equities at 67% versus 33% Canadian equities, as well as overweight to technology stocks at 39% of the portfolio. We've been rotating into this sector over the last several months and away from some of those defensive sectors that were leading the way at the end of 2022. Top contributors to performance actually in both Q1 and Q2 within the portfolio were NVIDIA as well as Oracle. So some of those tech-related names have really helped contribute to the portfolio here so far this year. Looking at the performance year to date, we do kind of see a lag that started in the first few months of the year, largely due to that defensive positioning that I mentioned, where a lot of those leaders at the end of last year were the ones that we had in the portfolio in January. Additionally, there was that brief period in March during which the entire financial sectors was pulled down as a result of the regional banking crisis. While our portfolio had no exposure to regionals specifically, positions in insurance and brokerages and a few other related names were pulled down in that period and subsequently removed. Since March, the portfolio has recovered really quite well and began approaching closer to benchmark year to date. This is actually better illustrated in the strong second quarter for the portfolio. You can see here a really good catch up. It did begin in mid-March. But for the second quarter, really strong for the portfolio, posting a 9% return and starting to catch up to the benchmark. I'd recently done some month-over-month analysis that we thought would be valuable to reiterate some of the strong risk management benefits of True Tactical. So in looking at this slide, I have two charts. On the left side, we're mapping the benchmark returns along the x-axis as well as the relative performance, so the performance of the fund minus the benchmark in the month, and we plotted that along the y-axis. So the chart on the left is for all periods since inception, which shows kind of a downward and right sloping trend line which suggests that as benchmark returns decrease and go negative, so towards the left side of the chart, the relative performance of the portfolio increases. I've also highlighted here some of the biggest underperformance came in periods where we were defensively positioned or transitioning out of risk-off periods, which are the kind of orange highlights. So some of those largest underperformance months are just periods where we were still trying to manage risk. Now the chart on the right is just months where the benchmark had a negative return. So it's essentially just the left half of the chart on the left. And for this portfolio, in those periods when benchmark returns are negative, the average outperformance for the Focus North American Equity Fund is 2.3%. And when counting all of those periods up, the portfolio outperforms 94% of the time. So I think this just really suggests that True Tactical is an excellent complement to reduce risk in portfolios during months of negative performance, really reducing overall portfolio volatility, and drawdowns is still an excellent complement to indexing portfolios as well as riskier assets or more volatile equity portfolios. So next, taking a look at the BMO SIA Focus Canadian Equity Fund. This portfolio, 100% Canadian equity, as the name states. Looking at the portfolio at the end of June, the highest weights to technology as well as Canadian industrials at about 26%. Over the last quarter, we saw strength in technology names really contributing to that performance, hence the overweight. So a couple names like Shopify and BlackBerry. Year to date, taking a look at the performance, we see a portfolio that has tracked the benchmark pretty well with a slight outperformance in back-to-back quarters. In Q2, here despite lagging slightly through April and into May, portfolio rebounded again into the end of the quarter just to take a slight edge on the TSX. Then having a look at those two charts once again, the relative performance versus the benchmark returns, we once again see that pattern of outperformance when benchmark returns decrease along the left. Also, once again, noting that at least some of the largest underperformance months come in periods of risk off or when we're being tactical away from equities, as well as some of those periods when the benchmark actually posts some of its largest monthly returns. When considering the risk management approach, when in periods when the benchmark returns are negative, the average outperformance is 1.76% for this portfolio with a 67% beat rate. So it outperforms at least 7% of the time so far. Again, quantifying the benefits of the True Tactical in periods when you really need it most. The next one we're going to have a look at here is the BMO Tactical Global Equity Fund. So having a look at this portfolio, there's a few broad-based names, a few sector-based ETFs, as well as 5 stocks. The asset class weighting is 60% to US equities, 26% to international equities, and 14% Canadian. We do once again see an overweight to technology as well as industrials. Technology for the second quarter in a row was a driver of performance, once again with NVIDIA and Oracle being those leaders in the portfolio and providing some really strong returns since being added to the portfolio. Additionally, with that US equity being the largest weight in the asset class, we did see recently a move in the SIA charts asset class rankings where US equity regained its top spot, and we believe the portfolio is aligned well with that. When looking at the year-to-date returns, so once again, the portfolio lagged in the first quarter, largely a big chunk of that happened in January, as well as in March. Both of those periods we saw rotation away from some of the names that were dragging the portfolio down. So in January through the next few months, we were getting out of those defensive sectors and into some of the more better performing sectors such as technology. Again, in March, there was that exposure to brokerages and insurance companies, which kind of the whole financial sector had a pretty bad couple of days. This adversely affected performance, but those positions were removed shortly thereafter. Now, taking a look at the Q2 performance, we see that the portfolio edged the benchmark by almost 1%. Like I said, really led by some of those technology names. And we're feeling pretty good about the positioning so far in Q3 going into the rest of the quarter. Returning to this relative performance versus benchmark month over month, once again, I feel there's a strong case for the risk management capabilities of True Tactical. We do have a few more data points here, given this is the longest standing portfolio that we've sub-advised for BMO Global Asset Management. Still that downward trend line suggesting that relative performance increases as benchmark returns decrease, and outperformance is more frequent when benchmark returns are negative. So for this portfolio, average outperformance is 1.19% for periods when benchmark returns are negative, while outperforming 75% of the time when benchmark returns are negative. Lastly, we'll just have a look here now at the BMO Tactical Global Asset Allocation Fund. So this is largely similar to the Tactical Global Equity Fund, which I just discussed. However, with a 40% position at this time in fixed income. This is largely consisting of Canadian fixed income with some exposure to U.S. Treasury inflation protected securities, as well as investment grade corporates. The fixed income portfolio currently has duration and credit mix similar to that of the benchmark for that segment of the portfolio. Similar to global equity year to date, the returns of the portfolio have lagged in Q1. Once again, that defensive nature in January, but that was subsequently rotated away from and into some of the stronger sectors, which has provided a nice rebound into Q2. So here's the Q2 chart, a strong outperformance with those technology contributors helping push the portfolio to just over a 5% return in the second quarter. And then once again here we see that risk management trend line making a case for True Tactical, with the larger underperformance months coming during those risk off periods. We can also see a much tighter spread to the benchmark, with only 2 periods lagging the benchmark by over 4%, and the majority of them are kind of within that range. So 69% of the time when benchmark returns are negative, you see the portfolio outperforming the benchmark, with an average outperformance in those periods of 0.71%. So once again, really outlining how this portfolio can be a great diversifier to any sort of equity or balanced portfolio. True Tactical really does show, at least historically, the power when the benchmark returns are negative. Now, obviously, that doesn't necessarily happen as often as positive returns, but again, we have been typically risk averse over the last couple of years, 2020, 2022, and so who knows what will happen in the future, but right now we feel like there's an excellent reason to hold something like any of these funds, because True Tactical can really help in some of those periods when you need it most. With that, I want to thank you for tuning into this update. If you have any questions, please don't hesitate to reach out. We're always available. Jason, Ted, myself, Colin, always happy to chat about the portfolios, chat markets, or if there's anything else that you're seeing out there, we'd be happy to take the time. And with that, I'll just flip up this disclaimer for a second, and want to thank you for your time, and we will see you in the next one. Cheers.